So what is the ICT turtle soup? The ICT turtle soup is a trading strategy focused on reversals and continuations that occur after false breakouts. It can be applied to any market, including stocks, crypto, forex, and futures. The idea is simple. Price breaks an obvious level, attracts traders into the move, and then quickly reverses. This strategy is built around three core concepts from ICT teachings: liquidity, liquidity sweeps, and market structure. Together, they explain why these false breakouts happen and how they can be traded with structure. Hello, and welcome back to another video here on the ComLucro channel. In this session, we break down the ICT turtle soup strategy and how it exploits false breakouts at key areas of liquidity. You will learn how to identify liquidity sweeps, understand why price run stops before reversing, and how to align higher and lower timeframes to enter with confirmation instead of guessing. By the end of this video, you will understand how turtle soup works within market structure and how to trade alongside smart money rather than becoming the liquidity they target. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now let us continue and talk about liquidity sweeps, because this is the event that activates the turtle soup setup. Without a sweep, there is no trade. A liquidity sweep happens when large orders enter the market and intentionally trigger clusters of pending buy or sell orders. This creates fast and aggressive price movements that often catch traders off guard. These sweeps always occur at buy-side or sell-side liquidity levels. They are not random. They happen where stops are concentrated and where the market can access liquidity efficiently. A sell-side liquidity sweep occurs when price moves down into a sell-side liquidity level, trades below it, triggers stops from buyers, and then quickly reverses back upward. A buy-side liquidity sweep occurs when price moves up into a buy-side liquidity level, trades above it, triggers stops from sellers, and then quickly reverses back downward. This sharp rejection after the sweep is the first clue that the breakout was not real and that price may be preparing for a move in the opposite direction. Next, let us talk about market structure shift, because this is the confirmation step of the turtle soup strategy. The sweep shows intent, but structure tells you whether that intent is being accepted by price. A market structure shift helps identify a potential change in direction. It shows when the previous control in the market starts to weaken and a new short-term bias begins to form. In a bullish market structure shift, price first forms a low. Then it creates a lower high, followed by a lower low. The shift happens when price rallies and breaks above the previous lower high, forming a higher high. This tells you that bearish control has been disrupted. In a bearish market structure shift, price first forms a high. Then it creates a higher low, followed by a higher high. The shift happens when price drops and breaks below the previous higher low, forming a lower low. This signals that bullish control is starting to fail. After a liquidity sweep, the market structure shift is what separates patience from impulse. It confirms that the move after the sweep is not just a reaction, but the beginning of a new directional move. So let us put everything together and walk through how to identify the ICT turtle soup setup step by step, on a bullish scenario and within an internal range context, which I will explain in more detail later. First, start on a higher time frame, in this case, the 1 hour. In the bullish scenario, your focus is sell-side liquidity, because that is where long stops tend to rest, below clear lows. Mark the most obvious levels, such as recent swing lows, previous day low, or previous week low. Then, once those liquidity areas are marked, wait for price to sweep that sell-side liquidity and close back above the level, returning inside the range. In many cases, this will appear as a candle that trades below the low and then closes back within the range, signaling a failed breakdown. However, in fast market conditions, this return can happen quickly and without much consolidation. After that, move down to your lower time frame, in this case, the 5-minute. This is the time frame you will use for execution, not for prediction. Here, you wait for a bullish market structure shift or a bullish change of character, meaning price starts to break above a key lower time frame swing high after the sweep, showing that bearish control is weakening. Here at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame buy-side liquidity. The same logic applies to the bearish scenario, with everything inverted. In that case, you focus on buy-side liquidity, wait for a sweep above highs, look for a bearish market structure shift, and then execute using the same confirmation and retracement principles. This process keeps you aligned with context first, confirmation second, and execution last, instead of chasing price or guessing reversals. This brings us to the two main types of ICT turtle soup setups, because context matters just as much as the pattern itself. First, the external range turtle soup. This setup happens when price moves outside of a clearly defined market range. Price breaks above a high or below a low, sweeps liquidity, and then reverses back into the range, often moving toward the opposite side. This type is commonly seen near range extremes and major highs or lows. This is the type of example we will demonstrate next on the chart. On a bullish external range turtle soup scenario, the context is defined by a trending market that temporarily fails at the range extreme. First, start on a higher time frame, in this case the 1 hour, and identify a clear bullish structure with higher highs and higher lows. In this scenario, your focus is buy-side liquidity resting above the recent highs, where short stops and breakout entries tend to accumulate. Price often makes a shallow pullback, sometimes not even forming a clear higher low, and then pushes above the previous high. This move sweeps buy-side liquidity above the high, triggering stops and attracting late breakout buyers. Then, instead of continuing higher, price fails to hold above the high and starts to reverse, signaling that the breakout was false and that liquidity has been taken. After that, move down to your lower time frame, in this case the 5-minute. This is the time frame you will use for execution, not for prediction. Here, you wait for a bearish market structure shift or a bearish change of character on the lower time frame. This occurs when price breaks below a key internal swing low after the sweep, showing that bullish control is weakening and that price is no longer accepting higher levels. Here, at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame sell-side liquidity. The same external range logic applies in a bearish market as well, with everything inverted. In that case, price sweeps sell-side liquidity below lows in a bearish trend, fails to continue lower, forms a bullish market structure shift, and execution follows the same confirmation and retracement principles. This process keeps you aligned with context first, confirmation second, and execution last. Next, the internal range turtle soup. This setup appears when the market is already trending in one direction. Instead of reversing the entire range, price makes a pullback, sweeps liquidity during that pullback, and then resumes the main trend. In this case, turtle soup becomes a continuation entry, not a full reversal, as shown in the first chart example. Now let us cover some of the most common questions traders ask about the ICT turtle soup strategy. These are the points that usually come up once traders start trying to apply it in real market conditions. One common question is whether you need to wait for a market structure shift to trade the ICT turtle soup. The short answer is no, it is not mandatory. Some traders choose to enter earlier by waiting for price to retrace into a key level, such as an order block or a fair value gap, after the liquidity sweep. However, it is important to understand the trade-off. Entering without a market structure shift means you are relying more on anticipation than confirmation. Waiting for structure provides stronger confirmation, while entering at an order block or fair value gap offers a more aggressive entry. Which approach you choose depends on your experience, risk tolerance, and execution style. Another common question is about time frames, because this strategy depends heavily on multi-time frame alignment. When trading the ICT turtle soup, the higher time frame is used only to mark buy-side and sell-side liquidity. It is not used for entries. If you are trading on the 15-minute time frame or lower, the 1-hour time frame works well for identifying liquidity levels. If you're trading on the 1-hour time frame, then moving up to the 4-hour time frame or higher is more appropriate for marking those levels. The goal is always the same: higher time frame for context, lower time frame for execution. So, what is the best time frame to trade the ICT turtle soup? From experience, this strategy tends to work best for swing-style trading rather than very short-term scalping. Because of that, the most effective execution timeframes are typically the 15-minute, 30-minute, and 1-hour charts. These timeframes provide enough structure, clear liquidity levels, and cleaner confirmations, while still offering strong risk-to-reward opportunities. Before we wrap up, there's one concept that connects liquidity sweeps, market structure, and real directional shifts in price. It explains what happens when price stops delivering in one direction and suddenly changes behavior, even when the structure still appears intact. In the next clip, you will see how a change in the state of delivery reveals this transition. Pay close attention to how momentum, structure, and delivery interact, because this is where many traders misread continuation and get trapped after liquidity is taken. Let us take a look. So what exactly is the change in the state of delivery? The change in the state of delivery, CISD, is a reversal pattern in which the price's momentum and delivery shift direction suddenly. In this example, you can observe a clear bullish trend. These 3 candles represent the most recent bullish delivery, showing strong and efficient momentum, which has pushed price above a recent structural level. This can also be referred to as the most recent buy-side delivery. Some traders mark the candle open as the CISD reference. In our approach, CISD is marked at the pullback extreme, just like change of character and break of structure, using the highest point in a bearish scenario and the lowest point in a bullish scenario. At this stage, the structure still appears bullish, and after a short-term correction, price would normally be expected to continue pushing upward. However, if price suddenly shifts behavior and delivers a strong bearish move, closing below the demand area and invalidating the prior bullish delivery, this condition is known as a change in the state of delivery. Understanding change in the state of delivery helps you recognize when price is no longer delivering as expected and when a real shift is taking place. This is a key piece that ties inducement, structure, and execution together into a complete trading framework. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.